Okay, now let's take a brief run through Chapter 10. Chapter 10 is all about current liabilities. So it starts off, first of all, and it defines what a liability is. A liability is a debt or an obligation of a business to transfer cash or some other economic resource as a result of a past event. So this this little thing here, this describes it well. So because of a past event, something that's already happened, the company now has a present obligation in the future to transfer an economic resource, whether it's cash or some other kind of asset. The liability, so it's recorded at the point in time when the obligation exists, that has the potential to require a transfer of assets upon settlement. So the example that they give here is a good one. Companies pay wages to their employees. You know you're going to be paying wages to them for the foreseeable future, but it's not a liability yet until the work is performed. So even though the company, Tim Hortons knows that it's going to be paying wages for quite some time, it's a liability once the work is performed. So usually people work, say if they get paid every 2 weeks. They work for those 2 weeks, and when the work is performed, then they get paid. So as that 2 weeks happens, you work on Monday, you work on Tuesday. You don't get paid right after you finish work. So as they work, they're owed money. That's the liability, and then it gets cleared out when they get their paycheck. So liabilities, current or non-current. So a current liability here, it's expected to be settled or paid within 1 year of the balance sheet date or within the company's operating cycle, whichever is longer. Most companies have operating cycles less than 1 year, so it's generally the 1 year. And they're expected to be paid by using current assets or creating other current liabilities. So for example, maybe there's an accounts payable that's going to be replaced within the year with a note payable. So you're replacing one liability for another. Non-current liabilities, they are not expected to be settled within the longer of the 1 year of the balance sheet date or the company's operating cycle. So current, expected to be paid within 1 year or operating cycle. Non-current, expected to be paid after the 1 year or operating cycle. Non-current liabilities are sometimes called long-term liabilities. We'll call them that often. Then we look at the current portion of long-term debt. So you'll see a lot of companies on their financial statements have long-term debt, and long-term, it's not expected to be repaid back within the 1 year, but a portion of it might. There might be a substantial amount owing, and usually there's payments made over time. So a portion of that long-term debt may be coming due within that 1 year. That would be the current portion of long-term debt, and it's due within, again, the longer of 1 year of the balance sheet date or the next operating cycle. And that gets reported under current liabilities. Let's see. Okay, something that's of relevance is right here. Dividing a liability between its current and non-current portions involves only the principal amount of the debt and not the anticipated future interest payments. Any interest that is accrued up to the date of the balance sheet is reported as interest payable under current liabilities. Interest relating to future periods is expensed in the period incurred. So when we report long-term debt and the current portion, it's not including the interest. Something else is demand loans. So sometimes there's a loan that doesn't have a fixed due date, but the creditor can kind of call the loan whenever they want. They can demand payment. So they're reported as current liabilities because the creditor can ask for payment whenever they feel like it. So it could be within the year, we don't know. So they get classified as a current liability. And I do think that's all in this particular section. Yes, be sure as you're working through each section to kind of, the answers to these checkpoints are at the end of the chapter, but kind of just give it a thought before you go ahead and look up the answer. Next, the chapter takes you, or the textbook takes you into known liabilities. So the company knows, in this case, who they're going to pay, when they're going to pay, and how much they're going to pay. That's what makes them a known liability. So that generally comes from like accounts payable, payroll, taxes, and that kind of thing. So we take a look at each one here in the book. So there's trades account payable, and that's generally what we refer to just as accounts payable, and that's amount owed to suppliers that you're in business with for stock items and products and services that you purchase on credit. And here, for example, an example of an entry would be to debit whatever supplies, so office supplies, and you credit your accounts payable for the specific supplier. Then there are payroll liabilities. That's amounts that you owe to your employees. So it consists of the amount owed to the employee for work that has been performed already, but it also includes income taxes payable, CPP, and EI, for example. And again, they work you through an example. So you have the amount owed. Well, this is what they've earned, office, so they have it broken out with office salaries and sales salaries expense. And then the amount payable, this is what the employees portion, that's for EI, income tax, hospital insurance, CPP, union dues, and then the amount payable to the employees. But then the employer also has to pay EI and CPP, so they record that as an expense, and that gets added to the amount payable. So for example, for EI payable, there's the amount from the employee and the amount that the employer owes. Then we move into taxes. So we have provincial sales tax. That's applied to sales to final consumers of products. Different rates are shown here. Let's see. So here again, they purchased something. No, here they're selling. Okay, so they've sold some furniture. So credit to furniture sales and PST payable, and increase in cash because they received payment in cash. And then later on they remit that amount to the government, so they debit the payable and then credit the cash account. There's also GST, and these all pretty much work the same. PST, GST, and HST, the same kind of entries happen for each. GST, which is the goods and services tax. Now, a few things to kind of look up and make sure you know what these all mean. Exempt supplies. These are services that are GST exempt. The harmonized sales tax is a combined GST and PST rate. Input tax credit, that's what when we make purchases, what we pay on our purchases gets recorded as an ITC, input tax credit. Receiver general, that's where we remit the GST. A registrant, that's a registered individual or entity that's selling taxable supplies, and they're responsible then for collecting GST on behalf of the government. Taxable supplies would be everything other than exempt supplies and zero-rated supplies. Zero-rated includes groceries, prescription drugs, medical devices, and such. So we look at GST, and then to give some examples, entries are done the same. And then we look at HST, which is a combined GST and PST. So again, the entries are all very similar. It's just a matter of which one you're using. We look at unearned revenues. So there are amounts received in advance from customers, but if it's for a service, for example, the service has not been performed yet, or the product hasn't been delivered yet. you receive the money in advance. So it's considered a liability until, if it's a service, it's considered a liability until you perform the service. So the example that they give here is advanced ticket sales. I think it's an airline, yes. So you pay for your airline ticket before you receive the service. So when you purchase the ticket, the company records it, they're receiving cash, and they have advanced ticket sales where they credit. Once the service has been performed, they debit the advanced ticket sales and then move it to a revenue account. Then we move on to current notes payable. So a current note payable is a written promise to pay a certain amount of money on a specific date. It's current, so that means it's within the 1 year or the one operating cycle. It's recorded as a current liability on the balance sheet, and they typically have interest on them, and so that allows the person or the company issuing it to earn interest until the payment is made. Okay, so they go through an example. Note given to grant extended credit. So here, someone had an outstanding accounts payable that wasn't paid, so they paid a portion of it, and the rest was turned over into a note. So there was an original $6,000 accounts payable. That would have been a credit. So now they're getting rid of the accounts payable, so they debit the accounts payable. They received $1,000 of that amount in cash. The remaining $5,000, they're creating a note payable for $5,000. And then, so it was a 60 days. So I should actually look at this. So on November 23rd, this was $6,000 payable. They agreed, they took $1,000 and the rest was on a 60-day 12%. Okay. Now at December 31st, at their year end, they have to accrue the interest that has been earned. So you take $5,000 times the rate times 12% times the portion of time. So out of 365 days in a year, it was outstanding from November 23rd to December 31st, which was 38 days. So 5,000 times 12% times 38 divided by 365 works out to 62.47. So interest expense is what they earned, and interest payable, 62.47. And here they show you how to calculate interest and how it's presented. So current liabilities, a note payable, and interest payable. And I think they do note, sorry, I'm trying to look at my notes and then find where it is here. They do note here somewhere. Here we go. The matching principle requires that the total interest expense be allocated over the term of the notes. That's why you recognize interest, like for example, each month, and not in one lump. Okay, so that's it for that particular section. Let me see. Yep. So now we're going to move on to estimated liabilities, or as they're sometimes called, provisions. So these are liabilities they're a known obligation, but the amount is uncertain, but it can be reasonably estimated. So they don't know the exact amount, but they can give a very good estimate. And they're sometimes referred to as provisions. Two of the best examples, the most common ones, are product warranties and income taxes payable. So now we're going to scroll down. Here we go. Customer awards loyalty programs. So that's one example. They provide, if there's a loyalty program of sorts, like lots of times you'll have, you collect points to use towards items from the store or discounts and such. So they provide a direct benefit to the consumers. They're recorded as a current liability, but they're uncertain. You don't know when they're going to be redeemed or if they're going to be redeemed. Sometimes these points expire and just sit there forever because they don't get used up. There's gift cards. They are Also, again, like you sell a gift card, but you don't know